Equity Market Update, May 2019. In May 2019, Indian equity markets performed strongly. S&P BSE Sensex and Nifty 50 rose by nearly 1.5%, driven by robust FII flows, fallen US Treasury yields, and general election results to markets' liking. The markets ignored the escalation of trade war tension between US and China and concerns over global growth. With elections behind, mid-caps and small-caps indices registered strong gains during the month. Sectoral indices performance was mixed, with capital goods, banks, and oil and gas being the best-performing sector, whereas healthcare, metals, and IT underperformed. Performance of global equity markets was weak. All major indices in US, Europe, and major Asian markets delivered significant negative returns in the month. This was primarily on account of escalation of trade war tension between US and China, with US raising the tariff on goods worth $200 billion from 10% to 25%. China also countered the move by raising the tariff on US imports worth $60 billion. During the month, BRENT crude prices corrected sharply by around 11.4% and closed the month at $64.5 per barrel. Most major commodity prices also fell in the month. This was primarily driven by concerns over global growth due to rising trade tension between US and China. Most other currencies depreciated against USD in the month. INR, however, ended the month at 69.7 versus USD, largely stable in the month, supported by recovery in FII flows and fall in oil prices. FPIs were net buyers for 4 months in a row and bought equity worth $1.1 billion in May 2019. Total FPI's equity inflows in CY19 YTD till May 2019 have been close to $10.9 billion. Equity-oriented mutual fund inflows moderated during the month of April. Net inflows in domestic equity-oriented mutual funds in April 2019 and CYTD19 were around 15 billion rupees and 193 billion rupees respectively. Q4 FY19 results of cement, chemicals, oil and gas, and corporate banks were better than expectation, whereas for retail banks, power and metals were largely in line with expectations. Results for auto, consumer staples, IT, and capital goods were below expectations. Nifty 50 is trading at price-to-earnings multiple of 19.5x based on FY20 estimated earnings and 16.5x based on FY21 estimated earnings. These are reasonable multiples, especially in view of improving profit growth outlook. Markets thus hold promise over the medium to long term, in our opinion. With the sharp decline in mid-caps and small-cap stocks over the past 15 months, significant divergence with large caps is not likely going forward. Adverse global events, rise in crude oil prices, sharp moderation in equity-oriented mutual funds flows, delays in NPA resolution under NCLT are key risks in the near term. In view of the above and expected recovery in earnings, there is merit in increasing allocation to equities in a phased manner or in staying invested, as the case may be, for those with a medium to long-term view and in line with individual risk appetite. Debt Market Update, May 2019. The 10-year benchmark G-Sec yield ended the month of May at 7.03%, down by 38 BPS over the previous month end. To support liquidity, RBI conducted purchases under open market operations of INR 250 billion in May 2019 and announced to do additional purchases of INR 150 billion in June 2019. Average liquidity was negative for most part of the month, primarily due to lower government spending on account of general elections. Net FII debt flows turned marginally positive with net inflows of $0.2 billion during the month as against net outflows of $0.7 billion in April 2019. In the first 5 months of CY19, aggregate net FII debt flows were close to $0.1 billion as against outflows of $4.5 billion in the corresponding period a year ago. INR ended the month at 69.7, a month-on-month depreciation of 0.2% against USD, primarily due to higher oil prices, which was offset by positive FII flows. The annual rate of retail inflation, CPI, increased marginally to 2.92%, up by only 6 basis points month-on-month, led by sequential rise in food and fuel prices. Core CPI moderated significantly on month-on-month basis to 4.9%, mainly on account of moderation in inflation in clothing and footwear, household services, and personal care. India's trade deficit for April 2019 increased to $15.3 billion from $10.8 billion a month ago, primarily led by lower exports of engineering goods, leather goods, textiles, and gems and jewelry. The aforesaid impact was partly offset by lower net oil imports. GST collection for the month of May 2019 rose to 1,003 billion rupees, approximately 2.2% higher than FY19 average monthly collection and up approximately 7% year-on-year. The average monthly collection required to meet the budgeted target for FY20 is estimated to be around 1,200 billion rupees per month. India's GDP growth slowed down to 5.8% year-on-year in Q4 FY19 from 6.6% in Q3 FY19, led by slowdown in investment activity and private consumption expenditures. Growth in gross capital formation declined to 3.6% from 11.2% a quarter ago. Growth in GVA moderated to 5.7% in Q4 FY19 from 6.3% a quarter ago, primarily led by slowdown in agriculture and industry, especially in the manufacturing segment. MPC, in its bi-monthly meeting held in June 2019, reduced the policy repo rate by 25 BPS to 5.75% and also changed its policy stance to accommodative from neutral. The reverse repo rate now stands at 5.5% and the CRR remains unchanged at 4%. In other measures, RBI announced that it will reduce the minimum leverage ratio required to be maintained by banks from 4.5% to 4% for domestic systematically important banks and 3.5% for other banks. In simple terms, leverage ratio is ratio between banks' Tier 1 capital to its total assets. In addition, RBI has set up a committee to comprehensively review the existing liquidity management framework. Outlook. The MPC's decision to reduce policy rate by 25 BPS was largely in line with market expectations, but change in stance to accommodative came in as a positive surprise. RBI also indicated that it will maintain adequate liquidity, which is likely to result in better transmission of rate cuts, in our opinion. This was the third consecutive rate cut by RBI, and it has reduced the policy rate by 75 BPS in aggregate in 2019. Given the near-term inflation outlook remains benign and growth is moderating, it could provide some space for further policy easing. However, any future action by RBI is likely to be data-dependent, and we maintain that this rate cut cycle is likely to be a shallow one, in our opinion. Large increase in gross market borrowings in FY20 over FY19, along with low demand for government bonds due to excess SLR in the banking system, could put upward pressure on yields at longer end. Even though the near-term inflation outlook remains benign due to low food prices and range-bound oil prices, we prefer to maintain a cautious stance. This is due to a modest uptick in growth expected in FY20, uncertainty regarding the monsoon, credit growth outpacing deposit growth, and likely fiscal pressures. In view of the above, the short to medium end of the yield curve continues to offer better risk-adjusted returns than the long end. Hence, we continue to recommend investment in short to medium duration debt funds. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.